Hello students and welcome to Finance for Engineers. In previous lecture, we had discussion concerned with risk and return, where you must have understood that there is a direct relationship between risk and return. Whether a company or business want to invest in any project or in any proposal, then they are taking risk. At the same time, they get returns from a particular project or proposal. The same case happens with the individual. Whenever an individual invests their money in a share market or in any financial security, they take some type of risk, and at the same time, they expect return from the particular financial security. So there is risk and return in any financial decision. So here we can say that there exists risk and return relationship between any financial decisions. Next is, after that we discussed about the cost of capital. We tried to understand what is the term or concept of cost of capital. So over there we discussed that the cost of capital is nothing but the rate of return that a particular organization have to pay to satisfy the people who are investing their money into the business. That means nothing, they are nothing but the providers of fund to the business. They can be equity shareholders, preference shareholders, or debenture holders. So in case of equity shareholders, we pay them return in the form of dividend. In case of preference shareholders, yes, again we are paying them dividend. In case of debt or debentures, we pay them return in the form of interest. So there should be an ideal mix by the firm of this debt or preference shares or equity shares, which will help to maximize the share prices in the market. Here we started with the discussion on cost of debt, and we tried to understand that the cost of debt is a rate of return that a company provides to the debenture holders or the creditors. And this is paid to compensate whatever risk they are taking while investing their money into our company in any organization. And second important part here is whatever interest paid to debenture holder is considered for tax deduction, and therefore the tax liability of the organization comes down, it gets reduced. And then we have seen the formula for calculating cost of debt, that is interest expense into bracket 1 minus tax rate. And now we will see an example concerned with calculation of cost of debt. So here an example, a company named Wiz Private Limited took loan of rupees 2 lakh from a bank at the rate of interest of 8% to issue company bond of rupees 2 lakh, and the tax rate is 30%. Here you are required to calculate cost of debt. So first we will write a formula, then see what is the interest expense. Interest expense is 8%, 8% on the loan. That is, the amount is 2 lakh. So 8% of 2 lakh is 16,000. Then into bracket 1 minus tax rate. So tax rate is already given to us is 30%. So like this, we will solve this particular example. And here you can see the cost of debt is rupees 11,200. In this manner, we can calculate the cost of debt. And here you can see interest rate payable is 16,000, but actual cost of debt is 11,200. That means cost of debt is less than the interest expenses. Why it is so? It is because interest payment to the debenture holder is tax deductible, and that's why cost of debt is lesser than the interest expenses. The cost of debt measurement thus helps us to find the financial condition of the company and also helps us to know risk level of the company, as if the debt of the company is high, then the risk associated of the company will be high, based on which investor take the decision of investment in the company. So you must have understood that the cost of debt has major element tax rate and interest expense. Once the cost of debt is calculated, then one can evaluate loan by comparing business income that loan has generated and cost of debt. This cost of debt provides interest expense, which later on helps in taxation. That will be a tax deduction. And next is this particular interest expense is used normally for tax saving purpose by the company, as treated as business expense. So now next we will see debt as a relatively cheaper form of finance. We have already seen various sources of raising funds, where we have seen four important aspects. That is, first one is equity shares, preference shares, then debentures, and loan from bank or financial institution. So here it is argued that the debt is a relatively cheaper form of raising funds for any organization. So let us see the justification of the same, why it is said here. So when obtaining external financing, the issuance of debt is usually considered to be a cheaper source of financing than the issuance of equity shares. One reason is that debt, such as corporate bond, has fixed interest payment, while in equity financing, however, there are claims on earnings. The larger the ownership stake of any shareholder in the business, the greater he or she participate in potential upside of those earnings. And another reason is the tax benefit of interest expense. The income tax paid by a business will be lower if the interest component of debt will be deducted from the taxable income. But the dividend received by the equity shareholder are not tax deductible. Law never recognized the dividend paid to the equity shareholders for tax deduction, and that's why the marginal tax rate is used when calculating the after tax rate. So therefore, it is said that the debt is a relatively cheaper form of finance. So now, next, we will move to cost of preferred capital, which is called as KP. This is preferred capital, that means preference share capital. The amount paid by company as dividend to preference shareholder is known as cost of preference share capital. Preference share is a small unit of company's capital which bears fixed rate of dividend and holder of it gets dividend when company earns profit. Dividend payable is not a tax deductible amount. So there is no tax adjustment required for comparing this with cost of debt. So this is about the cost of preference share capital. Again, the dividend paid to preference share capital is not tax deductible as like cost of debt, though they are getting fixed amount as a dividend. Preferred stock has higher return than bonds, but is less costly than common stock. That means preference shareholders get more returns when compared with debenture holders or bond holders, but it is less costly than the equity shares. The reason behind that is in case of default from the side of company, preferred or preference shareholders get paid before common or equity shareholders. However, in case of bankruptcy, the holders of preferred stock get paid only after short and long term debt holders' claims are satisfied. That means after paying to the debt holders, the preference shareholders get their money back. Preferred stockholders receive a fixed dividend and usually cannot vote on the firm's affair. These points we have already discussed while studying the long-term sources of finance, where in detail we have studied the features of equity shares, preference shares, and debentures. The same get repeated here. We should keep in mind that these preference shareholders receive a fixed dividend and at the same time they don't have any voting rights as such in case of firms affairs. So now next is formula for cost of preference share. So, so here you can see formula for cost of preference shares. You can find here two types of preference shares. For calculating cost of irredeemable preference shares, formula is given, while there is another formula for calculating cost of redeemable preference shares, where KP is the cost of preference shares, PP is dividend on preference share, NP is net proceeds from issue of preference shares, that is calculated by deducting flotation cost from issue price, then RV, that is redemption value, and N is period of preference shares. So let us see an example. The first example here is a company issues 20,000 irredeemable preference shares at 8%, whose face value is rupees 50, each at 4% discount. So find out the cost of preference share capital. So here in this particular problem or example, they have specifically mentioned that these are the irredeemable preference shares. We will apply the formula of calculating cost of irredeemable preference share capital. So let us see a solution. First, we will calculate dividend on preference shares. So how to calculate that? So it is already given in an example that a company issues 20,000 irredeemable preference shares at 8%. whose face value is rupees 50. That means 8% is a rate of dividend. 20,000 shares they are issuing, and its face value is rupees 50. So on 50, we will calculate 8%. So now the dividend on preference share is rupees 4. Next is calculate discount. So it is mentioned that 4% discount. They are issuing at 4% discount. So 50 into 4% will give you rupees 2. Now calculate net proceeds. So how to calculate that net proceeds? Face value is 50, but it is issued at discount. So discount we have already calculated. So 50 minus 2 is equal to 48 will be a net proceed. Now applying formula, you will get 4 divided by 48 will give you the cost of irredeemable preference share is 8.33%. So this is the formula which will help us to understand or to know the cost of irredeemable preference share. Let us see another example. So find out the cost of 10,500 irredeemable preference shares if issues at 2% premium. So earlier problem was concerned with discount, and here it is at a premium, and its face value is rupees 60 each. Then the dividend paid by the company is rupees 6 each, and flotation cost is mentioned rupees 8 per share. So first we will calculate the premium amount. 60 rupees is a face value, 2% is a premium. So premium amount here is 1.2 rupees. Next is issue price, 60 plus 1.2. So now total issue price here is 61.2. The premium, that means additional, we are charging more than the face value, that is premium. So now net proceed is 61.2 minus 8. What is this 8? This is the flotation cost incurred. So 53.2 is the net proceed. Now by applying formula, we get 11.27, the cost of irredeemable preference shares. So here we are ending the session, and in next lecture we will continue with the same unit, and we'll see cost of equity capital and other important aspects concerned with the financing decision. Thank you.